Yeah, thank you very much, Matt, and good morning, everyone. Thank you very much for joining us here today. I see a number of experienced and talented managers and board members on this call, so thank you very much for uh, stopping by to chat with us. The topics we're going to talk about today, uh, proactive capital project planning, reserves, reserve studies, keeping your study up to date. I think they've always been important topics, but I think there's a renewed focus on these topics. And if I were to ask the group maybe what happened over the past few years to renew that focus, I bet one of the items you mentioned would be the tower that collapsed in Florida. And certainly that played a role. But I think there's a lot more nowadays that's renewing this focus, putting proactive capital project planning at the top of the list for community associations, such as lending institutions like Fannie Mae, Freddie Mac, now utilizing reserve studies to increase scrutiny on the physical and financial health of communities. Wasn't a whole lot of that going on prior to Surfside. So in short, people seem to take these conversations way more seriously nowadays. My quick background before we get started, I'm a licensed professional engineer in several states, and I started conducting reserve studies with reserve advisors in 1999. But to this day, I still very much enjoy visiting a property like yours each week to help out with proactive capital project planning. One additional note to add on to Matt's note, if we don't get to your questions during this webinar, I'll certainly reach back out to you personally and make sure we address your questions afterwards at some point. Our agenda for today, and really, I think a lot of it's going to come down to that very last line. That very last line will be a critical point. The sooner association can get on a decent path financially, the better off they are as they age. Even a halfway decent path helps. And this is a somewhat tough topic at new properties. A lot of new properties, their big ticket projects, their capital intensive projects are way down the road. And so it's tough to get those newer properties to think about setting aside at least reasonable annual reserve contributions so that you build those reserve funds towards those big ticket projects, again, because they're so far down the road. But boy, so many of these new communities, if they would have just jumped on even a little, even a halfway, even a little decent path right from the very beginning, they're just so much better off when they age and hit those big ticket projects. I'm sure you've read and heard a lot about increased costs over the past few years. It really increased costs since the pandemic, since COVID. Ton of information out there about that. People mentioning this left and right. I'm sure you've heard a ton about this. You're well aware of this. And the topic of increased costs, it can be quite a complex discussion at a lot of major cities. Simply put, overall construction cost increases have far outpaced normal inflation levels. Now, some of those contributing factors, it may be labor shortages, maybe material shortages, or just simply costs went way up during the pandemic and never came back down. You see on your list here the increase in asphalt shingle roofing. But in the cities that I work in, all roofing types, including flat membrane roofing, have also increased significantly, gone way up past normal inflation. And a quick note here, depending on the city that you live in, lead times to get materials and actually complete the projects have also increased significantly. In fact, I heard that some major mechanical equipment like chillers, for example, it's taking several months to be delivered. That makes capital project planning and execution for managers and board members, makes it really challenging, very difficult. But it's really these increase in costs that have really played had a major impact on reserve studies really since COVID, since the pandemic. And we'll talk a lot more about that throughout this presentation. This analysis notes an association that delayed getting their reserve study up to date. And the bars on the right represent, first of all, the purple, if back to the original 2020 reserve study, That would have been the required annual reserve contributions to fund the reserve expenditures. Had this association completed a reserve study in 2024, obviously those increasing costs have a big impact. That's a big jump in the needed reserve contributions. But look at the green bar. The green bar is the results of waiting those 6 years to get their reserve study up to date. And now there's this much bigger gap. And those associations that kept their study up to date, and most importantly, gave an effort to put away at least respectable contributions, they made it through the pandemic and that high inflation, that high cost increase period okay. Because one of the biggest reasons is that it gave us the opportunity to gradually account for those big increases in costs. Gave us the opportunity to gradually account within their reserve contributions those larger increases in costs. And look, during the pandemic, I get it. Difficult financial times for all of us. Boards wanted to give their owners a break. I understand it. But unfortunately, for a lot of communities, the projects now need to occur and the funds are not available. What would have been fantastic is that costs would have increased at a normal pace. And if they would have increased at that normal pace, that purple bar would have been sufficient, or at least in the ballpark of being sufficient. But now the green bar, much more challenging, much more intimidating to get to. And unfortunately, the association's stuck with having to figure out how to pay for these projects. And now they have this funding gap that occurred because of the delay in getting the reserve study up to date. So when you look at the slide and you read those first 3 arrows, do any of those first 3 arrows sound familiar? Do they sound like a discussion point at the community that you're at or the communities that you manage? I bet they do. I bet you have some where that has been a common topic. When I first started, we'd see a lot of board members that were so proud that they kept their fees the same for many years in a row. In fact, you see a lot of board members running on vote for me, I'll keep your fees low. I hope you guys agree with me, but we see a lot less of that now. We see far less of that now. As board members, they seem to understand that keeping fees low for an extended period of time or keeping them the same for an extended period of time, it doesn't end well. And delaying a project, it may actually increase the overall cost to a community. I'll talk more about that in a moment. We'll show some examples. So I can at times, I guess I can understand the need to not increase the annual reserve contributions to the full extent during the years of maybe high increases in other operating budget line items. I can get that, especially like insurance. I know insurance costs have been going way up. That can make it really challenging to fund those annual reserve contributions. But it needs that mindset of we can't go all the way up to the recommended reserve contributions. It needs to come with an understanding that as you age, as the property ages, there may be a funding gap there. And that funding gap may compound as you age, may be more difficult to play catch up. One note that's on here, that's not on here, I should say, but really should be, is this concept of phasing projects over an extended period of time. When the money's not there, first thing that board president wants to do is phase those projects over an extended period of time. Just a quick note, phasing projects may or may not actually be a good thing for your community financially. If you're phasing projects prior to a low point in your cash flow, you could just be costing yourself money. You could be having to pay for mobilization over and over and over again. You could be cheating that contractor out of the ability to give you the lowest unit cost for the work. Phasing is not always the answer, and yet it's what everybody goes to. Need to very much understand where you're at within your financial cash flow to know whether phasing will help you or actually hurt you. So this funding drift, this is really a case of one issue leads to another. and the situation can really snowball downhill quickly. We quite often see this board paralysis. We see this board paralysis far too often, actually, where the board knows they have a problem. They know what they need to do to fix the problem. They know what it costs to fix the problem, but they don't want to raise the reserve contributions. They don't want to special assess. They don't want to take a loan. So they do nothing year after year. Again, because they don't have the money available to take on the project. So they defer the project. Sometimes they defer the project until the conditions become critical. They become a major problem. And at a minimum, quite often those costs increase because each year that goes by, that deterioration gets a little bit worse. Again, we see that board paralysis all the time. I was at this property recently where on one hand, the board was telling me that they are very much in favor of funding their projects from reserves. They want to, at all costs, avoid special assessments and loans. Love the attitude. Great attitude. I applaud their approach. That only works if you're setting aside the appropriate reserve contributions. The problem with that community is the mindset that won out was, well, we need to keep our fees, quote, affordable, keep their fees low, so they weren't putting away the reserve contributions. And thus they didn't have enough money for the projects when the time came. And it resulted in a massive deficit that they had to find a way to make up. And guess how they made it up? Special assessment and loan combination. So another quick note on that story here. I've always wondered when a board says we have to keep our fees affordable, how do they know what all owners within their community can and cannot afford? We'll talk a little bit more about their job being to maintain the investment of the owners, not to save people money here in a moment. So I had a manager in this very situation. The manager kind of made the comment that this really applies to all associations who are trying to keep their fees, quote, affordable, keep their fees lower for owners. They made the comment that owners that can't afford the reserve contribution increases probably can't afford the special assessments either. I thought that was an interesting comment. So I mentioned on this slide, deferring projects may actually cost you more in the long run. When it comes to deferring projects, so you're looking at your capital budget for the year, are there projects, what projects do you have to take on? What might you be able to push back? I'd really recommend not deferring projects that the cost may increase as time goes by, or projects that if you defer the project may result in leaks in the units. Masonry is a good example of this. And masonry, this is really masonry in climate where there might be freeze-thaw cycles. Concrete's another example, especially in areas with freeze-thaw cycles. Each year that goes by, that minor deterioration becomes a little bit more major and costs more to fix. With respect to masonry, masonry facades, masonry building exteriors, each year that goes by, those minor issues, those minor cracks get a little bit worse and may result in water infiltration into the unit. Roofing is another one. I don't have a picture of a roof on here, but deferral of roofing systems, what's the risk there? The risk is you could increase the potential for water infiltration into the units or damage to some of the substructure materials, the substrate materials, which then in turn, when it comes time to replace the roofing system, results in a higher cost. So as part of the update process, our engineers consider the rate of deterioration. So did the rate of deterioration, did it get worse? Did it increase? If it got worse, that rate got worse, we probably have to move the projects up. But a lot of communities, maybe they apply some good preventative maintenance. Maybe that rate of deterioration decreased. That's fantastic. Then maybe we move some projects out. We always try our best to help associations establish a proactive approach to these capital projects. Again, to get to the small stuff before it comes critical or leaks into a unit. When I visit a property, and a lot of my work are high-rise structures, I'll often ask, what is the history of facade repairs? And they'll often respond with, the client will often respond with, well, if it leaks, we fix it. So that's their program of maintenance. They wait till something leaks and then they fix it. Well, it's not very proactive, right? That's not getting to the small stuff before it becomes big stuff. So we try our best to get associations in a more systematic, proactive approach to maintain their building exteriors so that you're not resulting in the water filtration. All right, so you guys are going to think we made this up. I'm honest truth here. We did not make this up. This is a real example. Two identical properties. They came to us at the same time. Identical buildings, identical construction, age, size, both built about 1985. And their first reserve study was in about 2013. Both faced really tough financial decisions at the time of the original study. In fact, they were both faced with about a 60% annual increase in their reserve contribution. 60%, that's a massive increase in their reserve contribution. Condo East, they made the tough decision to increase their contributions. They didn't want to head towards special assessments and loans. They wanted everyone to pay for the use of the association maintained components each year they live there. So they made the tough decision to increase their contributions. Condo West, they took the approach of keeping fees low. They only increased by 5%. Thus, each year that went by, the Condo West deficit got worse. And the notes you see on this slide are based on what the properties looked like at the time of a recent update. And I think what I like about this example is it really demonstrates that kicking the can down the road has serious consequences and serious challenges when projects can no longer be deferred. I also like that that shows Condo East in a much better spot because they made that difficult decision many years ago. And the mindset that I'd love to see people have for these budgeting discussions that you're about to dive into. Some of you may have already started. I see some proactive managers on this call. The mindset I'd love your boards to have is that the fiduciary responsibility of the board of directors is to maintain the investment of the owners. It's not to save people money. And now I'm not saying you take the highest bidder, you don't consider costs. I'm not saying that at all. But at the end of every decision, I'd love to see that mindset govern, that the fiduciary responsibility of the board of directors is to maintain the investment of the owners. One other quick case study here. And for this case study, it's important to note that this property, it's of older construction. And thus they're facing some repair and replacement projects, repair and replacement of some components that typically have quite a long useful life to them. Components could be piping systems, electrical systems, components that a lot of newer communities don't have to deal with, or at least hopefully they don't have to deal with, assuming that there aren't any defects, construction defects there. So this property, obviously a high rise, 16 stories, and because of their age, they're having to find a way to take on some pretty serious projects, again, that a lot of communities don't have to even think about. Now, the projects that they do have to take on here in the near term, roofing systems, not in great shape at all. Water infiltration, they've repaired as much as they can. Water beneath the membrane, so there's no, it can't really overlay this roof system. The insulation needs to be replaced. Big ticket project. Masonry, pictures really don't do justice here. This property has a significant amount of masonry work to deal with. And obviously, masonry on a high rise, just getting to the masonry is a challenge because of the scaffolding, the drops to actually get to it to conduct the repairs. And they also have some major HVAC equipment that requires replacement. Now, important to note here, especially the roofing and the masonry, these are projects that they've really been deferred long enough. And if they continue to defer, those costs are going to continue to go way up. They've actually already increased, but a continued deferral will just make that situation much worse. So the association really needs to dive into these projects. Now, bear with me here. I know this slide's busy, so just bear with me. I'll try to walk you through it. I actually do really like the message here within this slide. I understand it requires a little bit of explanation here. So first, I'd love to see you focus on those blue or darker colored bars, as they represent the annual contributions if the association were to follow the previous study, their last reserve study. What would the reserve contributions be if they were to follow that last study? And you can see there's some pretty large blue bars in the near term because they're having to play catch up. For a long time, this association did not set aside appropriate reserves. Now they have to take on these projects, and now they're playing catch up. So you see some big blue bars in the near term representing that catch up. The orange bars, so now we come back a number of years later, we get their reserve study up to date. They're not putting away the reserve contributions, not even really close. They have these projects that can't be deferred any longer. So now when we recalculate, at the orange bars. First thing that should stand out, those additional assessment orange bars, the very large additional assessment orange bars. It's just too late to build your reserves for some of these major projects. So they're faced with major additional assessments, loans, some means of funding other than reserves. But you look over time, those orange bars are well above the blue bars. Again, because they weren't, even if they would have just been on a halfway decent path during their original study, it would have closed that gap between the orange and blue bars. But now you have a pretty large gap plus the additional assessments. So a much more challenging scenario. And I think that this scenario demonstrates how this issue of funding a drift funding gap, it compounds over time. And again, I mentioned earlier, I really should mention, we're here to help associations make informed decisions. It actually doesn't matter to me how you pay for big ticket projects. We just want to help you understand what projects are coming down the road, their potential times, their potential costs. So this association, as long as they were aware of this need for special assessments and loans, that's one thing. But this association was trying to fund their reserves. They were fighting that battle. They were trying to fund reserves appropriately to fund the expenditures, but they were also trying to keep fees low for their unit owners at the same time. And it ended up being quite a challenge because they were quite a bit behind on their contributions. So a key message here, that time allows for smaller, more manageable adjustments. Getting your study up to date in a timely manner allows for smaller, more manageable adjustments. We can more gradually build in those contributions. And whenever there's a need for increases in the contributions, and I know this is state specific. For example, if you're in Florida, I know this is a different game here, but in most states, when there is a need for an increase in the contributions, we try our best to step or phase in those increases, step or phase them in gradually. But that's only an option if there's time and your major projects are far enough down the road. If your major projects are right away here in the near term, there's no time to step or phase in those increases. You're facing a special assessment, loan, means other than reserves to fund your projects. Those associations that stay on top of getting their studies up to date, there's usually that time for us to step or phase in those increases gradually. Now, there's a limit to how many steps or phases we can include because each step or phase defers that cost burden a little bit to future owners. We want to minimize that, of course. But we do our best to help out associations, help them build up to where they need to be. So normally on this slide, key update indicators, I would talk about how older, more complex communities likely need to get their reserve studies updated more often. Newer, less complex communities, they can get away with a little bit longer interval. And important to note here, this is independent of state specific. If you're in a state that requires reserve studies at a certain interval, that's a different discussion. States that don't require reserve studies, those older, more complex properties, a lot of projects going on, a lot more projects on their plate, likely need to get their studies updated more often. Now, what's going to be interesting here is that I have heard a number of associations being asked by lending institutions for reserve studies that are 3 years or less. And just to note, Community Associations Institute, their recommendation is a reserve study be get updated at 3 years. So that 3 years or less mark, it's going to be interesting to see how that plays out, as lending institutions like Fannie Freddie can be quite powerful. So we'll have to watch this all together and see how this plays out here. Before getting into a couple of the notes on this slide, I wasn't quite sure where to put this discussion, but I wanted to, it does come into play in getting your study up to date at times, and that's funding a loan. Use of a loan to take on major capital projects can be a great option. It can be a great option to take on the projects right away, kind of defer paying off that loan, the payments, especially if you don't have reserves available. Of course, having reserves available would be the ideal scenario, but if you do not, use of a loan is becoming quite popular. If you're going to use a loan, you obviously have to figure out how you're going to pay off the loan, right? Silly comment. Of course you know that. Associations that, we'll see associations quite often fund their loan payments from the annual reserve contributions, which is okay. But you have to build in those payments into your overall reserve contribution calculations. Some of the worst financial situations I have ever seen are associations funding major projects from a loan, making the loan payments from their annual reserves, from their reserve contributions, but they didn't build that into the reserve contribution calculation to how much you're putting away. And the result is that a very large amount of their annual reserve contributions are taken up by loan payments, with very little going towards future parent replacement. It's a massive mistake that I see, and it gets associations in a lot of trouble. The note about project-based, the bottom left. Just before a project, or maybe you let the dust settle maybe just after a project, can be a great time to take a fresh look at all of your components, take a fresh look at your finances, and make sure that your path after that project is a good one, is one where you're not going to end up in a financial deficit. You make your way through that major project, and you're on this path that moves you forward through the next projects in a smooth fashion. The bottom right is fairly new, but it's quickly moving up the list of reasons to keep your study up to date. And that's, as I mentioned earlier, the lending institution, the new lending institution guidelines and requirements utilizing reserve studies to evaluate risk. A manager made the comment to me. She said that lending institutions are becoming the policing authority over association finances. And I think we're probably headed that way. Depending on what city you live in, there are some cities I work in where lending institution scrutiny is extremely intense. And then there's others where it's really hit or miss. I could mention lending institution scrutiny to a manager in some of these other cities, and they may not know what I'm even talking about. But I think it's heading throughout the entire country. And the guidelines that were recently noted, the guideline changes from Fannie Mae, Freddie Mac a few weeks ago, I think that the ending of the limited review is likely going to bring this lending institution scrutiny to a lot more communities. And just one note of clarity, that those new guidelines require the annual reserve contributions, a bare minimum, a minimum from 10% now up to 15%. So they increased from 10% to the 15% level. Our understanding directly from Fannie Mae is that the 15% governs. In other words, as long as the association is setting aside a minimum 15% of their annual income towards reserves, and there's some other little stipulations about that annual income, some stuff excluded, some stuff not included. But in general, 15% towards the annual reserve contributions, they're good, regardless of what an association, regardless of what a reserve study states. So a reserve study may state 50%, but as long as that association's put away that 15%, our understanding is, at least from a financial standpoint, they're good. Now, they may not be from a physical standpoint, that's a whole different ball game, but financially, at least on paper, they comply. We'll have to see how that all plays out. The cost, so this is sort of like a concluding takeaway here, concluding note here. The cost of a reserve study is almost always less than 1% of the total expenditures that an association will face at most townhome, mid-rise, high-rise, and some of those bigger HOA properties. So in other words, keeping your study up to date and keeping you on a path that maintains the investment of the owners is well worth the cost of that update, well worth the cost of getting that study up to date. Keeping your study up to date also improves the chances that time will be on your side and will allow for those smaller, more manageable adjustments. Now, it's also important to note here, wanted to highlight again, that even minor drift away from the required reserve contributions compounds over time and can be really, really challenging to make up that difference when projects absolutely need to occur, when you can't push that project off anymore. In my experience, and I hope you guys agree with me on this, associations that keep their study up to date and at least give an effort to get close to those recommended contributions, they're just better off. They're better run. They take on projects in a timely manner and with a scope of work that does not cut corners. And I hope that you agree with me in your experience.